Emerge went down to 1 cent a share in December of 2023, right before we sold our pet business for 13 million Canadian roughly to Tiny. And that was like a big lifeline for us. We took all that money, we paid down the debt, we announced a refresh plan. A few years later, we're about 10x.
Welcome to Build a Business Worth Buying, the podcast where seasoned entrepreneurs, M&A experts, and world-class operators share behind-the-scenes stories of building, scaling, and selling remarkable businesses. I'm your host, Aaron Alpier, and every week I sit down with people shaping the world of acquisitions, founders who cashed out, buyers with bold strategies, and advisors who help make deals happen. This is not a podcast for beginners. It's for those who know the grind and want actionable insights to make their next big move. Get ready to take notes, rethink your strategy, and hear untold stories of what it takes to build a business worth buying. We've got a great guest today. Ghassan Halazon is the founder and CEO of Emerge Commerce, a company built around a bold idea that swept through the consumer internet over the past decade. What if you could acquire dozens of profitable niche brands and scale them faster together than they ever could alone? Through Emerge, Ghassan had pioneered one of the earliest public roll-up platforms for digital consumer brands, focusing on Canada. The company acquired businesses across food, sports, pets, and enthusiast commerce, all with the thesis that shared infrastructure, marketing leverage, and operational scale could unlock additional value. Emerge had their share of ups and downs before going public and having a $150 million valuation to seeing everything crash down to only 1 cent. And yet their story of being able to put this together and come back is one that's really fascinating. Today's conversation was really enlightening for me. We explored what the roll-up wave got right, what it misunderstood, and what founders building consumer companies need to know if they want to build something truly worth buying. Ghassan, thank you so much for being on here. I've been really looking forward to this interview.
Likewise, thanks for having me, Aaron.
So you've done so much. I mean, you've built and scaled some companies in your own right. You've got this roll-up. I want to kind of talk a little bit more specifically about Emerge Commerce. Why don't you first, I guess, in your own words, tell us what Emerge is and kind of how it came to be?
We are an acquirer and operator of profitable e-commerce brands and technologies. Originally founded about 10 years ago with this notion that building e-commerce companies from the ground up was a very expensive proposition back then, and even till today. A lot of e-com companies have really challenging climates, low margin, high churn, and just sort of a rising customer acquisition cost, a lot of competition, a lot of reliance on the big giants, the Metas and the Googles. And so it was always really tough to crack that code. And I think the Emerge, from my perspective, having been in this space for 15 plus years, was sort of a smarter way to build profitably. And that's to say, buying kind of small to medium-sized e-com businesses that already had EBITDA today, not tomorrow, was potentially the way we wanted to approach, the scale up. And we've been through a lot of iterations, but as I said, today we're sort of really zoned in on this sort of profitable niche portfolio.
Yeah, that makes a lot of sense. I mean, the joke in startups is if you raise $10 million, you're giving $9 million to Google and Meta. And
right.
So I can imagine how difficult it'd be. Were you able to find like a large selection of brands that had good EBIT numbers? Because I feel like that for a long time was always such a fleeting metric that people had. And it was always, we'll be profitable tomorrow.
Right. And the essence of Emerge coming up when it did was this idea that suddenly there were these e-commerce enablement companies, obviously Shopify being the poster child, but a lot of other tech out there was starting to make it possible for 7 people in a basement to run $1 million EBITDA business on Shopify, or in some cases on Amazon, etc. And so for us, it was timing. We sensed that, at that moment in time, that there were, I would call it hundreds, if not thousands, of profitable bootstrap e-commerce businesses. But had you done that, had you looked at that in the early 2000s, that wouldn't have been the case, right? Because you needed a huge tech team, you needed to build your own platform, et cetera, and that was very costly, and margins were extremely low, and there was the big kahuna, Amazon, and then there was everyone else. And I think to some extent that's still the case, but there's no shortage of mean, lean, profitable businesses. Now, the bigger question becomes, if you are a $1 million EBITDA business and you're focused on profit, when you look at the economics of that sort of business on your own, it's a little challenging. Like, where do you go from here? It's either a lifestyle business, but then it's not really a lifestyle because it's a lot of work, right? Everyone knows e-commerce is a really sort of hands-on industry. So that's the allure, is like, from our perspective, to go acquire these, kind of proven businesses. They're not growing crazy, right? Because if they're growing crazy, they think they're worth $1 billion, and that's not our game. Like, it maybe it's someone else's game, but for us, we wanted to buy stuff where we could foreseeably and plausibly see that there's a market leadership position on the horizon, if not already achieved, in a particular niche. So True Local, market leader in Canada in meat and seafood subscription specifically, right? Not in all of grocery. Same thing with golf. Like, it's a very niche, specific sport with a diehard community. We acquired the market leader in golf experiences in Canada, a brand called Underpar. And then we've now sort of leveraged that to expand into other businesses, both organically and through acquisition. So I think the more, the moral of the story, I would say, over time, because Emerge broadly started as a diversified portfolio of all sorts of stuff. We were in pets, we were in outdoor gear, we were in experiences, we were in travel. So we were sort of an aggregator of sorts. And we made mistakes like many others did, and the tide turned on that broad, diversified model. What we found is, like, going focused and going niche is the way to go. So within golf, we're going deeper and deeper. Within grocery, starting with meat and seafood subscription, we're going deeper and deeper. So that would mean potentially acquiring competitors or adjacent businesses like pet food, things that really make strategic sense, rather than just going broad and expanding and acquiring EBITDA for the sake of it.
Yeah, no, I want to dig in that a little bit more because that's so interesting. Because you're right. I mean, the aggregator model was one where enormous sums of money were brought to bear,
About
and it
20
seemed
billion
that
or so, I think. Yeah.
people were fighting with everybody about what they could get, and I imagine it was quite the bidding war. And so I'd love to understand, what was it like trying to buy businesses in that environment when it was kind of the go-go days of aggregation, and then what was the maturation looking like on your side, where you guys said, you know what, let's just do a couple things really, really well instead of trying to chase these things.
Yeah, you know what? I have a very interesting take on this, because we didn't really follow the trend of aggregation, i.e., the Thrasios of the world that were the poster childs of. Really, Amazon FBA aggregation was the primary theme that raised a lot of money to go acquire, like, these little Amazon stores. There was some Shopify roll-ups as well, but, like, to a lesser extent. We were neither. We wanted to take our prior experience in building a venture-backed e-commerce company, which, by the way, I didn't mention, but my original foray into the space was at the tender age of 25. I left my banking job in New York to co-found basically what was the Groupon of Canada at the time, the deal space. Very difficult space, but we grew it from like 0 to 50 million in our mid-20s. It was a lot of fun. It was an adventure, but it was venture-backed, and as the space fizzled, we were forced to sort of retrench and tuck it in with another sort of business and so forth, and those never end all that well. But we came out of it thinking, look, there's a smarter way to do things, and that's to go acquire profitable businesses. The reason I don't pair what we did with the really the Thrasios of the world is because we were really always, and I think, by the way, that's why we're still here and kind of reinventing ourselves and still alive and kicking and now playing offense again. We just acquired a company last week. I think the reason is that we really zoned in on a brand and community. So what we bought wasn't just EBITDA and wasn't just a bit of financial arbitrage, because a lot of these little Amazon stores, 3-person shops, you're potentially competing with Amazon itself sometimes. There's SEO problems. It's really not the same as buying the number one meat and seafood subscription business in Canada, True Local, right? True Local is a brand. It has a diehard community. It has pricing power. It has amazing CLTV to CAC, $2,000 versus a CAC of $125. So there's certain things that we did that I think put us in a position to withstand the storm that came. And to your viewers that aren't aware of the storm, or really the double storm, it's a lot of this happened during the pandemic highs. So everyone was buying businesses at the peak pandemic, right? 2020, 2021. And we all know that not just e-commerce, but the Zooms of the world, the Pelotons of the world, all of that sort of came crashing down at the same exact time. Interest rates on debt went up to went up at a historic clip. So that's now suddenly you're dealing with EBITDA portfolios of EBITDA shrinking while interest rates are going up, and that's a recipe for disaster. And that's how 98% of the space got eliminated. What we had to do at Emerge, and how we survived this, and sort of why we moved past it, was we said, look, like we're sitting. First of all, we always bought stuff that was profitable. We always bought real brands. We always bought either market leaders in their particular niche. So I think even within pets, we had a wholesale B2B pet platform, very specific thing that in the US. And so when the time came to have to make decisions around where do we double down, where can we win big, let's say, and where can we, kind of offload some assets to pay down debt, the underlying assets in the portfolio were real. Like there were $2 million EBITDA businesses, there were $3 million EBITDA businesses, and that's essentially how we knocked down 30 plus million in debt down to 4 million in net debt.
That's amazing. When you're thinking about paring back a portfolio, and so I mean, you have such an interesting perspective because you're simultaneously buy side and sell side.
Right.
When you think about these assets that are performing, and they have positive EBIT, how do you determine which ones you're going to keep and which ones you're going to liquidate?
Yeah. So it starts with a couple of things. We had to really look inwards, right? And when we say we look inwards, it's about where is our core competency? What have we been able to do well through the years? I don't want to only say well, disproportionately well, right?
Mm-hmm.
Where do we have an edge? And the answer quickly brought us back to Canada. So first of all, our assets in Canada, our assets where we had deep expertise. So we went back to our roots, essentially. I didn't say this earlier, but we started. The first verticals we had were in golf and grocery. After the deal space and all of that, we kind of went into golf and grocery. And then when we went public, we started buying up, all the pets, the outdoor gear, adventures, etc. So we went beyond our comfort zone, in part because capital was thrown at us, and we made the mistake, like everyone else, to go out and start buying a bunch of stuff, right? But essentially what we really did was we unwound the buying that happened during the pubco, and we kind of brought everything back to basics, to the businesses we understood in the country we have an advantage in and market leadership position in. And then underlying that was we also really believed and saw signs from a data perspective that True Local on the one end, i.e. the Butcher Box of Canada, and Under Par, some call it the Golf Now of Canada. It's not exactly apples to apples, but we kind of compete in the space of discounted golf. Both of those businesses had terrific customer bases, great CLTV to CACs. That's the holy grail. In the end, when I say brand, community, good unit economics, all of that in the end boils down to two words: CLTV versus CAC, right? If you have a good model, people are sticking around, they're spending more, they're telling people, and you have a great CLTV, and that by that same token, relative to your customer acquisition cost, you are favorable. If this is favorable, everything else is manageable. Because suddenly, what is it a game of? It's a game of, okay, any of these categories has a decent enough TAM, right? If you're the market leader in any of these categories, name a category. If you're number one, it's worthwhile. And then B, your SG&A, you need a certain level of discipline. That was never our problem. Today, we run on about $1 million per employee in revenue. That's one of the most efficient ratios in all of e-commerce, right? I know there's a lot of talk about AI, one-person companies. We're not there yet, nor do we want to be one-person company. But I definitely see us, if we were a $500 million company, I don't know if we could be a 500-person company only because of the facilities and infrastructure. But I think we're going to be really sort of zoned in on keeping that as close as possible to $1 million in revenue per employee. And so SG&A has never been an issue. So it just becomes a matter of, can you spend the marketing dollars in such a way where customers are going to stick around, buy more, tell people, and do so early on in a way that you can have your ROI, early on, within months, not years.
Yeah. What I'm hearing from you is it sounds like you guys have spent a lot of time really understanding who you are, who you want to be, grow up. You have a very clear thesis of what the problems you want to solve. Where do you think that confidence as an acquirer comes from?
Yeah, to be honest with you, Aaron, like it really has been a whirlwind, and maybe in some ways we could argue more complicated than it should have been, right? Because I think this conviction now in many ways comes from just having made those mistakes. And it's kind of like sometimes they say you got to make those mistakes. Sometimes they're very expensive. In many cases, people have gotten wiped out by making those types of mistakes, i.e., too much leverage or buying things that they didn't fully, understand or in the wrong time. Those are very costly mistakes. We're very fortunate to have made it through the storm. But I have to also say, because it's not just luck that we survive, like there's credit to the team A to Z, in terms of the group that said, no, we're gonna clean this up. We're not bailing here. Like we're gonna fight this out. We're gonna rework. And by the way, like I personally rolled my sleeves up and had to make a choice to say no. I'm not bailing on the investors that put the money in here. Many bailed. The entire space bailed effectively.
Yeah.
We were here. I said I'm gonna renegotiate with the lenders. We're gonna be very transparent with our team and staff and employees, and we're gonna double down where things are working, and then we're gonna really incentivize the stars that stuck around that we think are the future of this company. And so that this it's a big sort of incentive realignment and org realignment around what matters, what are our goals, what if this company 10x's from here. How does that all add up? And we had to really think about those tough choices. The conviction in my voice that you hear is because we've been through hell and back, right? We've been through hell and back. And now that we're back, like we're going at it with a vengeance, right? Like, we don't have to be negotiating debt, like, with back against the wall. I'm negotiating debt now to save 4 or 5 more points in interest, by the way. That's a different negotiation. Before it was just, let me breathe, let me live, let me try to sell some businesses. I promise I'll pay you. Well, now 25 million senior facilities down to 5.9 million. Now I'm like, they're saying, thank you. Why don't you stick around with us? Don't leave us to go to the bank. Right? So that's a very different vibe right now. So you hear the energy and the excitement. It's because we just bought a company last week. It's because the company that we bought last year, we made our money back on it in 90 days and we announced it. So things are exciting now because we're like, finally, we've learned from our mistakes. We've learned from a lack of focus. We've learned from too much debt. We'll never make those mistakes again. Now we're really excited to get going, play offense again.
Yeah. I mean, when you say those things, of course, like, to the casual listener, like, well, yeah, of course, you don't have too much debt. Focus on EBIT. Those things are there. What was it about going to hell and back that you think you had to learn that made it kind of a core part of your DNA and soul, as opposed to just something that you casually went through? And do you think you could have gotten there a different way?
Yeah, excellent question. I think that, some of the big learnings that came out of this was like, look, like we were in a close to zero interest rate environment. We had, because of COVID, e-commerce became the hottest space on earth. Every sector at some point becomes the hottest space on earth for a minute, right? And that was our moment in e-commerce. And so the learning there was like, you think, I said, the moment you think you're invincible is the moment you no longer are, right? That's my saying, by the way, if you like it. But it's so true, right? You start getting this vibe that you're untouchable, and people throwing money at you. That you're supposed to buy companies, so let's just buy and grow it. And we did grow it. We grew to 120 million in GMV at the peak, and we had 4 million EBITDA instead of 6-7 million EBITDA. Still good EBITDA, but what does that matter if your debt's 30 million and your interest cost on the debt alone is 6-7 million, right? So what mattered was like this movement to shift our focus on optics and vanity to like really, really hands-on combat and stuff that really mattered. Like genuinely at our core, what really matters in business. Cash flow matters in business. Not EBITDA, not adjusted EBITDA, certainly not just revenue. Cash flow. That's where we're focused. That's why a company we acquired last week, not only did we offer adjusted EBITDA sort of figures, but we talked specifically about the cash flow that it delivered last year. And that's how we're sort of eyeing this new phase where Emerge is now a cash flow positive company. Could we have gone into it in a different way? The most obvious answer, in hindsight is, yeah, we raised all this capital at the peak. We could have just said, no, screw you. We're going to be disciplined. We're going to take our sweet time. We're only going to buy companies, very opportunistically. People around us wouldn't have liked it. We had a lot of transactional folks around us. We had bankers. We had investors that were rushing for us to grow. And there are other, this aggregator is already at $1 billion. This aggregator is raising 100 million. You got to go, right? And so there was all that pressure. So it's very easy to be like, no, I could have just taken the capital and hung around for a few years and then picked everything up dirt cheap. But by the time we had the debt problem and the declining revenue problem, it was kind of like, no, there was no other way to do it. Honestly, I looked this up because Emerge went down to 1 cent a share in December of 2023, right before we sold our pet business for 13 million Canadian roughly to Tiny. And that was like a big lifeline for us. We took all that money, we paid down the debt, we announced a refresh plan. A few years later, we're about 10x where we were there, but we're still nowhere near where we're looking to go. But that was sort of like there was no other way to do it. You had to negotiate with everyone at the table. You had everyone, and everything was negotiable, as I like to say, and that's what we did.
Yeah, that makes a lot of sense, and I can certainly appreciate the pressure of looking around and wondering like, are they going to eat my lunch? Are they going to go around me? Right? Like I have to kind of go with the tide, so to speak, just to keep up with what's going on. Do you get the sense that that pressure of growing and acquiring and just pushing yourself to keep up with the Joneses, was that more from a thought of like, hey, we may want to sell this company one day, or we may have a big payday our way, or was it more of a this is just the new paradigm and that these valuations are crazy and it'll work itself out in the future?
Yeah, I don't think we specifically, in our mind at least, had a sense of selling the company because I always, in the back of my mind, knew that a holdco or an aggregator model was more so the buyer than the seller, right? Like it's hard to imagine someone buying grocery and golf and pet like there aren't unless a bigger aggregator were to do that, right? Except we didn't look like the other aggregators. They were more like, here's a bunch of Amazon stores, or there was a bunch of Shopify stores. Like we're an oddball, like sort of aggregator, if you want to call us that. We're not. We weren't playing by anyone's rules. We were making it up. But I think the pressure was more what I said, which is like a lot of people gave us capital with the expectation that we were going to be a powerhouse acquirer. And so we had head of M&A, and he was bringing deals, and we were signing LOIs, and people were asking, well, why aren't we deploying the capital, right? Like even some people were giving me shit for not deploying the capital, like in a particular month, like i.e., like why you said you might do a deal by mid-year, like why hasn't that happened by it's July now? Like deals don't work that way. Like you need to make sure you have the headspace and the breathing room to think through and structure and negotiate. Compare that to this now, just to give you a sense. Our last two deals, which are now public, in this new cycle, what we call Emerge 3.0, because Emerge 1.0 was the diversified portfolio, Emerge 2.0 was the turnaround for a few years, the cleanup and the redo around grocery and golf. We focused inwards. And now 3.0, we're back on offense, but we're only acquiring opportunistically and strategically. What does that mean? The last two businesses we've picked up, we've acquired at 2 to 3 times EBITDA. They're both cash flow positive on day one. Compare that to the prior cycle where we were acquiring companies for 5, 6, 7 times EBITDA, right? So A, we're acquiring lower. B, we're not only focused on EBITDA, we're focused on cash flow. And C, they have to be synergistic with what we're already doing, right? So golf, last year we acquired a company called Tee 2 Green. It fits perfectly in our golf portfolio. We have one experiences business, one marketplace business, and now we have an offline business. So the trio with 400,000 members is a big reason why the company that we acquired last year is now not only like fully cash flow positive, but we've grown it by 30%. We made our money back on the acquisition. Talk about a return on investment. We dished out the capital last year. We made our money back within 90 days on the upfront payment, and we've since cash flowed way more than that, right? So that's the winning formula. Buy low, buy with synergy, and buy opportunistically. In that case, it was a retiring founder. He'd done it for 30 plus years. He wanted to make sure his team had a good, kind of landing, and he did, and they did, and he made money, and he's happy. He's also taken some shares in Emerge, and that's pretty much doubled since he's taken it last year, right? So that is a winning formula, and now it's like all about rinse and repeat. That very, very specific thing that we've landed on, versus buying big picture sexy with multiples that, by the way, 5 to 7 times EBITDA is not outrageous by any means. But
Yeah.
for us, it mattered a lot because when it came down, suddenly that probably feels like 10 times EBITDA, 15 times EBITDA, right?
Yeah.
Because everything came down.
Yeah, well, I mean, what strikes me with what you're saying is just you guys have such a intentionality to how you pursue these deals and how you vet them out. I kind of want to go into that direction a little bit more. When you have these criteria, whether it be a segment or the fact that it's EBIT profitable or it's Canadian first, are these treated as hard filters for the deals that you look at, or are these things where you look at everything and these would be excuses for why you might have a higher multiple you're willing to pay?
No, we have a very, very specific criteria. The business has to be organic revenue positive. It doesn't have to grow fast, but it has to be slightly positive, at the very least stable. Like we're not looking to fix things. We're not looking to turn around things. We just turned around it took a few years out of our lives turning around Emerge itself. We want to buy stuff that's stable. So that's the starting point. We want to buy stuff in and around, we call it 700K to 2 million in EBITDA. That's kind of a good sweet spot. Really, right now, last few deals are more like 800K to a million EBITDA. Those are the last two. So we're kind of probably focused there. Eventually, we'll make our way up to 1.5, 2. But we say we're open to opportunities in and around that zone. It has to be cash flow positive. In general, we like asset light businesses, or at the very least, an ability to prove that not only are you're EBITDA positive, but the way you handle your inventory, your timing, your overall model, you've been able to cash flow, right? Which is rare. I will say it is rare, especially in e-commerce. That's what attracted us to Viral Loops. That's a recurring revenue model. It's a B2B enablement business for referral and customer acquisition. And it comes with 500 B2B clients, but more importantly, it comes with cash flow today, right? Like it's not just EBITDA to cash flow conversion is through the roof. It's like 86%, right? That is never the case in e-commerce, almost, right? So in consumer, I mean. So we want it stable. We want it EBITDA positive. We want it cash flow positive. We want a long-standing track record. We don't want something that just started 2 years ago, right? So we're like 5 to 50 years, we say. You know, T2 Green was 38 years, old school business, right? True Local just celebrated its 10th year. Underpar, I think, is on like 12 years now, a bit more maybe. So we're not looking for the sexiest and highest flying stuff. We're looking for stuff that works, that has an underlying customer base, that is loyal, that is supportive, and that spreads the word organically.
Yeah, that makes sense. When you're evaluating a potential deal, what are some of the triggers that would encourage you to maybe go higher from a multiple perspective? Where you're like, you know what, we would be willing to do 4 or 5 or 6 or 7. Is it more of like the fact that it's a competitive deal? Is it, you're saying that synergistically, like, hey, I can plug this into my golf network and we can triple this thing in 90 days. Like, talk to me about how that analysis goes on inside Emerge.
Well, right now we're not looking to do deals at much higher than what we've been finding them, for the sole reason that we're finding them at these levels. So we're happy with what we're finding. It's a buyer's market in many ways, and I think it'll continue to be a buyer's market, frankly. If we were to move higher, it would be the latter. It would be more like synergistically, we knew that we could plug something in and right away gain by applying our audience, our ad tech, and sort of fill a gap that we're missing, maybe geographically or something of that nature, right? But we wouldn't go much further up, because I'll tell you something. In all my experience in e-commerce, the number one indicator of the success of an acquisition, this is probably going to be a fact worldwide in all of acquisitions, not just e-commerce, is the price you pay, right? When you buy low, chances of you making a return on that investment are just so much higher. The risk is so much lower. And like a lot of people tell me, I've screened 100 companies and I didn't find a single one that made sense. And my vantage point on that is the problem is probably you in that case, because it's not really that there's 100 companies that aren't worth selling. It's that you're not figuring out what the right price is for those, right? So in an extreme example, if something, had, I don't know, 500K in EBITDA, so really small EBITDA, would the deal be good if you did no upfront and $1 million over 3 years or 5 years? Like maybe, right? Like, I don't know. Like it depends on the deal structure. Now, some people might argue that's not worth the hassle. Maybe. It depends on whether you have the infrastructure to handle it or not, right? Like if something landed on my lap that was a bit smaller than we wanted and wasn't growing, maybe shrinking a bit, but I could get it for no upfront, and you laugh, but like I've seen that, I've done that in certain cases. Like there's ways to get creative with structure. So it's really a structure question. I wouldn't say all deals are worth making at any price. There's some deals that are just not, like, too much of a headache, especially turnarounds, that even at zero, like you couldn't pay me to do them. But mostly if you can structure it the right way, a deal can make sense if you have a platform.
Say a little bit more about kind of what things you would see that kind of kill your appetite for a deal.
It starts with people, right? So someone I don't trust. That's the starting point. Someone that doesn't want to share information, doesn't give me a good take, or someone that is dishonest about the information. Once we're looking at it, if we find in our data, for example, that while revenue numbers look good or COGS and all of that looks good, but we look through the data and we find that it's off and they give us some bullshit answer and we've lost that trust. That the problem with that then becomes like we don't know what we're buying. Even if they don't come with it, we just don't know what we're buying anymore. Like he or she's lost credibility with what they presented to us. So what's to stop them from, suddenly, the accountant's not even on the books, like stuff like that, right? So it starts with the trust piece. The second thing is very weak EBITDA to cash flow conversion. We need to see how that EBITDA converts to cash flow ultimately. If it's very weak, then it's not real like EBITDA doesn't matter, honestly, right? The whole point of EBITDA is that it's a good proxy for cash flow. If it's a bad proxy for cash flow, it's not going to work. Number three, and this is something more of a learning for us, but we're probably going to shy away from totally seasonal businesses. We're happy with golf. It is a seasonal business, but there's no unless we would rather less lumpy, especially as a public company, would rather less lumpy revenue. Yeah. And that's what Viral Loops does. It's like pretty stable software across the quarter. So that's another reason we like it. Like it kind of reduces the lumpiness. But beyond that, if it's EBITDA positive, if it's stable, if it's cash flow positive, I guess the other pillar is also like disruption. There's a lot of talk about AI now, right? You got to make sure that your bases are covered and that you're tech and AI forward in a world like today's. But I think for us, we take an optimistic view on the world. Like when we look at a company, we're excited. Like if we like the math, if we like the EBITDA, the cash flow, the stability, then we're more interested in what we can do to make it better, right? But certainly I think for us, people is at the front of that list of the no-go. If something's wrong with the people, then like we really shy away from the deal. And we don't go for overly competitive deals. Like it's okay if it came through a broker, but it's not our forte. Like generally every single deal we've done to date, except one, has been direct. It's been through my relationships, our relationships, and we've just done it with no finder fees, which is also something you save on over time if you're able to.
Yeah. That's great. When you guys are assessing what you can do to make a potential acquisition better, I feel like those are always rose-colored glasses, and people tend to overestimate what they're able to do, either from a bandwidth perspective or capability perspective. What's the framework that you use? Do you kind of say, all right, if the team thinks we can triple this business, let's cut it by half and say like that's probably what will happen? Or are you organizing so there's specific teams, specific bandwidths that you're going to ignore the other businesses for a while and focus on this one? Like, how does that actually come to fruition?
I've done this enough to agree with what I think you insinuated, which is that synergies are really tough word to believe these days, and
it's what you put in the Excel sheet to make the math work, right? Like
exactly. So you bring up a good point. The math has to work with zero synergies the way we model it. And not only that, and I'll give you a concrete hard example. The math even has to work if you sensitize it down 10 or 20%. That's a little extreme, but like let's use Viral Loops as an example. Our latest acquisition, we just announced it. It's an 800K EBITDA business. It's a 700K cash flow business. So really, as I said, 86% EBITDA to cash flow conversion. And we bought it for 2.3 million, so about 3.3 times cash flow. Okay, and very opportunistic. The seller had some debt issues. They're focusing in another area, kind of what Emerge went through a few years ago. So we jumped on it. We acquired it very efficiently. And right now when I look at it and I say, okay, technically, if nothing changes, we should make our money back in 3 years. That's extraordinary, by the way, right? I know T2 Green was a whole nother level. We made our money back in the same year. That I told my board not to get excited about that idea. We can't replicate it. It was a very unique situational. But in terms of where we are here, essentially, when we looked at Viral Loops, our latest acquisition, we said, okay, if this thing goes down to $500,000, would we be okay with it? And it's like, oh, so you make your money in 4 point whatever times. And it's like, okay, yeah, like that's still good. That's still 20% a year, hurdle rate. Like, I mean, at 700, it's like 30% potentially, right? And so we've already said we expect to exceed our return on invested capital of 25%, which is best in class. Like, you know what I mean? Like private equity is like 18 to 20 at best, and those are the best in the world that do it. So I think that that's kind of how we view it. Like we're not putting pressure on just the growth element. Now, however, do we think there's growth opportunity? Yeah. Like they don't do a particularly great job with SEO lately. We think there's opportunity there. We obviously think there's opportunity in taking their customer referral technology and applying it to True Local, Underpar, Just Golf Stuff, etc. And so that's all sort of icing on the cake. But for us, it's more like that's why I said stable. It has to be stable, it has to be cash flowing. Then it has to be a good price that you buy it at. Then it's okay. Maybe there's some upside here as well on top. But the upside we can't factor into our budgeting at all.
Yeah, that is such a refreshing take to hear because I feel like so many times when you are a holdco or you're an aggregator, the pressure is not just to maintain the cash that you have. It's not to maintain the cash flow. It's like, oh no, we exist because we need to 10x these things over some period of time. And so it's nice to know that you can bring on these brands, bring on these teams potentially, and just say, keep doing what you're doing. Let us know where we can help, and your board, your investors are okay with that. At the same time, I'm sure that you would love to 10x them, and so I'd love to kind of understand a little bit more about how do you integrate these companies,
Yes.
and do you keep the team? Do you swap people out? Is it kind of an asset purchase, and you're
Right.
plugging things in?
So you bring up some good points. To be clear, the reason we're okay with it is the price, right?
Mm,
If we bought it for 5 million or 7 million, it wouldn't be okay. You'd need to, this pressure. This goes back to my point about price being so key, right? Because when you buy low, you can make your money back in 3 years, and you'd be very happy with a 30%, 33%, return on invested capital, right? Because that's extraordinary. But if you bought it at 5 million or 7 million, that math doesn't work anymore. Suddenly, you might as well put the money in an index if you're not going to, right? So, so that's number one. I do think that I'll be clear too with T to Green. We bought it and also modeled it in as flat. There's 1 million in EBITDA. But over the first few quarters, we grew organic revenue from 3% historically, right before we bought it, to about 31%. So like a 10x in organic growth. Again, I don't want anyone to get too used to that magic, right? Because it was a situation that really worked well, and it tied into the fact that we brought our audience. Imagine 10 stadiums worth of golfers announcing to them, here's all these, new pop-up stores, new equipment,
yep.
discounted equipment from, TaylorMade, Callaway, Adidas, Puma. It worked like magic, right? And then lo and behold, because we bought this boring old school cash flow business, T to Green, 38-year-old business, they never really deployed any advertising dollars on Meta and Google. Imagine is that there is
Wow.
still such a thing in today's world. So we look like magicians. We come along, right? We buy low, 2 times EBITDA, 2.2 times EBITDA. We apply our ad tech. We apply our 400,000 members. What do you get? You get a 10x in organic growth. So those are the types of deals I like these days. I like deals that make me look like a genius. I know I'm not, but I like ones that make me look like one. And
Yeah.
credit to the team, by the way, just to be super clear, because I'm not operating that business. So when I say I mean we, and the golf team under Morris Finn and the amazing leadership and drive that he's brought to the team.
Yeah, that's such a great story. Um, Talk to me about kind of you've been a founder, you've sold businesses or exited in general, and now you're kind of sitting across the table from these sellers. What is some advice that you would have for someone who is thinking to sell their business? What are some aspects that maybe they are underselling or underemphasizing that actually make a big difference to an acquirer like yourself?
Um, I always feel that there's a premium. It goes back to the authenticity and that relationship side of things. Like never underestimate the emotional side, even with ourselves. Like if I feel good about you, I'm more likely to you pay a little more or listen to you on certain things that matter more. Like so like I feel like it's not all numbers. Like it really isn't. I know we're also trying to be like we're a buyer that's going to care for your staff, your brand, and we do. We've never changed a single brand in our lives, and I mean it, and I always bring that up. And in Emerge 1.0, we stood true to our mantra, which was at the time, we're going to be founder friendly, let them run the business through the earnouts. It wasn't our damn fault that everything came crashing down.
Yeah.
And then a lot of them abandoned ship because it wasn't interesting financially for them, and I get that, right? They're missing their earnouts, but we let them run their ships. And when came time for the hard work, we had to roll our sleeves up, and we did the heavy lifting on cleaning these things up and bringing them back. So I would say from a seller perspective, I think integrity, I think like under promising, over delivering, I think transparency, like, no one's perfect. Like I like folks, I'll say this, like just because like this, I really value this point as I think of it. I really, really admire founders or managers that look, we're looking to buy a business, and they call me and say, I really want you to know about this thing. I don't think it's a big issue, but I need you to know this is a concern of mine. I never say I'm not doing the deal, and I actually never use it against them, right? But I love the transparency, and it just makes me feel like, okay, well, if he's telling me this stuff voluntarily, then I'm going to trust everything he's telling me or she's telling me about the future of this business way more. So if I had to boil it down, it's really just that trust factor, that integrity, and that communication and clarity. That is number one above all else. The numbers are the numbers. The business is the business. I can do all my research. I can bring the experts. We can do a quality of earnings. But then it's that integrity piece and that clear communication and the under promise over deliver thing, man. That's so invaluable.
Yeah, you can't undersell that enough. I mean, I think that the interesting thing here is that oftentimes people just look at EBIT as if that is the end all be all, and that's the only thing that matters. But EBIT is an input, right? And kind of what I'm hearing from you is that it is a relationship, it's a conversation, it's a understanding of like, I understand what you're trying to do, I understand where we're going, is there a fit here? And so I think that's like the finer part of deal structure and diligence that doesn't get a whole lot of attention. And so maybe you can say a little bit more there, because I feel like when most people think about due diligence, I put together a secure data room. Yeah. Here's all my financials. Here's my trademarks. Here's my formulations, etc. Whatever I need to do, and go look at it. Let me know if you have questions. How do people think about going beyond that to really figure out what matters, and how do you balance between wasting time and actually making it valuable?
Right. I think the other point that ties into all of this is for I'm putting my advisor hat to sellers is to really figure out what's super important for you yourself and for your shareholders in the process, and to relay that as early as possible, right? Because at the end of the day, at least in our case, I can't speak for all buyers, we're all ready. I always say we're ready to roll our sleeves up and get creative if we're in the same zone here, broadly speaking. If we're from different planets, there's nothing to talk about, right? But if we're big picture aligning around, say, a valuation or a structure, we've been so creative in figuring out how to bridge gaps. As long as we have a willing seller that communicates clearly what they need, why they need it, or if there's special circumstances or any of that, there's always room to bridge. But we can't guess this stuff ourselves, So I feel like a lot of deals would have died, I will tell you, even on my end, on our end, if I just said, okay, fine, we can't do it, let's move on. But always asking that extra question, like, what if, like, how can we, right? Using words like this puts everyone in that mindset. So same thing from a seller perspective. Say, okay, I see you revising your offer. It's not quite what I need. Here's why. Is there a way to do it this way? Is there a way to do it that way? Like always, if I'm a seller, I'm always putting it back. I never understood sellers that just walk away, right? Like I'll put it back till the buyer says I'm not. Maybe they're afraid of rejection, but like, what's the point? Like, why not push the buyer to figure out what you need and keep pushing them in that direction? And then worst case, even if you don't do a deal, at least you've set a new benchmark for next time. If you're going to revisit it with them, say a year or two down the line.
Yeah. One of the things that's impressive about your career and what you've done is that you've seen this M&A space play out over several years and several different epochs of e-commerce. What sorts of things have been consistent in terms of what is valuable in building a business that someone else wants to buy? And what do you think is new or getting more attention today than it had in years past?
Look, I think the truth of the matter is it sounds like businesses in general, startups, I'm sure e-commerce especially, but a lot of startups are starting to zone in on this idea that, the bottom line is the top priority and what counts the most. We always viewed that lens. That's why there was not a single company that we bought that was not profitable, ever. Despite all the issues, like we really never said we'll just buy a loss-making thing here or there. And so I think that's a new wave, and it's a healthy wave, and it's more grounded. Valuations in general, I think, are more grounded. And that's better for the ecosystem because you don't want sellers thinking their businesses are worth way more because of their emotional attachment or excitement about broader comps. Well, if a comp is 500 million in revenue, you have nothing to do with that. A $5 million business has nothing to do with a $500 million. Don't even compare. Oh, the market leader in our space is 5 times revenue. Like it's irrelevant. Like that's a company with scale and defensibility and technology, and like don't compare it, right? At the same time, you got to look at not just your EBITDA as an owner. You got to look at what are you taking home, and like you got to look at that math, right? Like, oh, million in EBITDA, but then after tax and then after reinvesting in inventory, like what is your take home, and how long do you want to do this, and why do you want to keep doing it? And the alternative is, if you have a good brand that's growing reasonably and it's profitable, then you got to ask yourself, like, do you want how do you take this to somewhere interesting, or how do you exit it, get a reasonable sum for it, and potentially earn out or sweetener that keeps you in the game somehow, tied to the long-term performance as an upside if the thing actually makes it one day bigger, and then you get to do something else eventually. So I mean, I think just being grounded and realistic, likewise from Emerge's lens, like I think one thing that hasn't changed, even though it wasn't as popular, is brand and community win. In an ever changing world and all this chaos. At the end of the day, someone could come and tell me, we can replicate the True Local site with AI in 4 minutes or whatever. It's probably true, by the way. Um, but then I'm going to say, where are you going to replicate those farmer relationships over 10 years? Where are you going to replicate our golf course partnerships and relationships and banking partnerships to promote these deals, and integrations with all these different platforms and workspaces for professionals. And so it's a full thing that we've built out, and it's a relationship business. That's why retail and e-commerce, for all the shit we've taken as being, a cutthroat industry and low margin industry, it's a people's business and it's a relationship business, and brand and community above all else, always. Everything can be replicated, but not at the end of the day the way people feel about your brand. And that's why we've invested and doubled down where we have.
Yeah, that's helpful. The last topic I want to touch on with you is how Emerge went public itself, because it's a very unique thing that you don't hear all the time. You guys went public via a reverse merger, a SPAC. Can you talk to me about what was the rationale for going public at that time in that way, and what advice would you have for people who might be considering something similar?
Yeah. You got to be ready for some gray hairs along the way. That's for sure. I
I'm already
think
way
that,
ahead of you.
yeah, it's one of those things that somehow was baked into our DNA. The folks that had raised the early capital were public market type folks on Bay Street. They had a lot of connections, and there were a lot of investors interested in Emerge as a name being public. And we got a lot of outreach from bankers and investors and news outlets. And early on we were piecing together on a per deal basis. We would sign a little LOI, $1 million, go shop it, raise the capital. A lot of stress to do it that way, bit by bit, deal by deal. And so the allure of us going public at a really exciting valuation, I think the peak valuation for Emerge was something like 150 million when we went public, and right after we acquired our first a few businesses being public company. So there was a lot to be excited about. It's pretty common in Canada, the reverse merger structure, the mini SPAC, if you will. Um, and my advice in general is, like, first of all, understand that these sort of venture exchange style public companies, they're not an exit in them and of themselves, right? If you're doing a multi-hundred million or billion-dollar IPO on the NASDAQ or New York Stock Exchange, those could be considered partial exit. Like a lot of times the capital raised for secondary and Here, you're still like proving things out. And so it's not a real exit. So why would you do it? There's a few reasons you would do it. In my opinion, now kind of coming back and looking at this, I'm imagining myself outside of Emerge. Would I do this again? There's a few reasons to do it. Number one, if you have a business that does not need the market right away, so you're cash flow positive, you don't need the market, you're not beholden by the market, you can operate the business with a long-term lens, then the advantages become, so that's an if, by the way. So first, if you're at a point where you have strength, then it could be very powerful to have a public currency that you can leverage for M&A, for capital raising, and that's opportunistic, not to save your company or anything. It's more so you want to go at it with strength. So you look at the Constellation softwares of the world that have built over 20, 30 years. They were always profitable, even when the market didn't rate them well, didn't matter, didn't even bother to do earning calls. I'm not saying that's the way to do it, but at the end of the day, if you can build sustainably a curve of cash flow growth over 10, 20 years, then being public, you get the benefits of it. I mean, there's some overhead and there's extra cost and it's waste of time. In many cases, a lot of paperwork and that sort of thing. It's very annoying, I must admit. And when you're down, and it's really painful because the thing that people don't talk about is, a private company could raise venture capital and borderline be bankrupt 2 days from now. Yet there could be an article on TechCrunch saying it's worth 200 million or whatever. The next day it goes bankrupt. There's no recalibration of your share price, publicly, right?
Right.
But here, if your debt's high, if your debt's too high, you can go down to close to zero. And that's a public thing. Like from a psychology perspective, you have to deal with people around you that look at your stock and that it's 1 cent to share. But yet when it's exciting, which is, again, a lot of people say, why didn't you go private during that downtime? And I said, you know what? We were just too focused executing the comeback. And now we're in a position of strength. Now it gets exciting because if we execute, the market will reward us handsomely. Our share price is up 10x from the low, but it's still 10x plus below where it once was. And that's what excites me now because, we're building a model that's leaner, that's more profitable, that's cash flow positive, that acquires only synergistic stuff. And now the market's on our side in a way because they're like saying, oh, okay, so you've dug yourself out. Now let's see, can you do this again and again and again? Because if you can, you're going to get a premium very quickly. Suddenly we can get way higher valuations than a private company can, right? So the ultimate arb in being public is, being valued at 15, 20 times EBITDA, but buying stuff at 2, 3 times EBITDA.
Yeah.
That'd be, e-com heaven, essentially.
That'd be pretty sweet.
Right.
So I hope you guys get there. Well, Ghassan, this has been a fascinating conversation. Thank you so much for being on. I've certainly learned a lot. I'm sure our listeners have as well. Before we wrap up, we've got one question that we always like to ask our guests on Build a Business Worth Buying, and that is, what is the best example of a moat you've seen another business build?
I'm going to say something a little contrarian right now because I think they're in the heat of it with this AI eats software narrative out there, and the company's Constellation Software. Constellation was at its peak $100 billion company. I think it's 40 to 50% below its peak as a result of these AI scares. Yet, their growth, their cash flow, all of that continues. But there's this sort of narrative right now that AI might crush software, and in some cases it is crushing software. The thing I like about Constellation is the way it's been built. It's been built very methodically, very disciplined, focus on return on invested capital. That, like I said, with some of my examples, really high thresholds, like 25%, I believe, is their threshold. They've done it over 20 plus years. They've acquired hundreds, and I think 300, 400, 500 companies already of different niche software companies. No one really cares to disrupt these small niche type businesses that are very old school government type contracts, where I think it's being mischaracterized and misread. And I just think that as a Canadian story, it's still so quiet. It's still so covered. Everyone in the tech space now knows it because it's one of the largest tech companies. But the way they've built it, the consistency, the discipline, the transparency, these are things that make it very admirable and make this sort of it's quite a moat. Like tech can come in the way and whatnot, but the cash flows at the end of the day, that's my big word these days, right? If you haven't noticed. The cash flow on this thing, the discipline, the diversification, the decentralization. But this was always designed to be the ultimate moat. And it's sort of a mini Berkshire Hathaway in a way. That's sort of the mantra here, is that you're buying businesses that collectively are way better than the sum of the parts. So I'm just a big student, a big fan of the space, and I believe they're going to thrive and come back from this as well themselves.
Yeah, what a great example. We usually hear like the Apples or the Amazons or stuff like that, but I love that. I'm going to learn more about Constellation. And thank you so much for being on, for sharing your wisdom, sharing your time. Wish you and the rest of the Emerge team nothing but success. Hopefully you guys find lots of great companies to buy. If there is a listener here who has a company that might be a good fit for you, what's the right way to get in touch with Emerge?
Easiest is LinkedIn, Ghassan Halazon, or my email, ghassan@emerge-brands.com.
Thanks for joining me on Build a Business Worth Buying, brought to you by Izba Consulting. I hope today's conversation gave you real insights into scaling smarter, selling better, and thinking like a strategic operator. If you found value in this episode, make sure to subscribe, leave a review, and share with someone who's building their own sellable business. Until next time, remember, the real win isn't just building a business, it's building one worth buying.